Folks, one of the things that I love to do is grow and learn. And one of the things that I've been very clear about is I've never done big apartment deals. I was lucky enough to go to Jonathan Swamley multifamily event last summer in Vegas. And I want to ask him about a series of tweets that Ken McElroy is sending out because I believe both of these guys play in the same space and I don't. So I wanted to get his feedback. Jonathan, how are you?
I'm good. How are you?
I'm doing very, very well. Thank you for being here today.
As
Obviously, I'm sure you've heard of
always.
Ken McElroy. Yeah,
Yeah, I mean, Ken McElroy, one of the very first books I read about real estate investing, long before I even got into the business, was by Ken McElroy. So I've always thought that he was one of those guys out there who really knows his stuff, and kind of personally gave me my first
hmm,
education in the space, actually. So yeah.
very cool. Well, folks, what I'm going to do today is I've pulled up Twitter or X. I follow Ken McElroy. I'm going to go through a couple of his tweets. I'm going to read them and let Jonathan kind of react to them. So the first one, Jonathan's a little bit long, so I'll go through it in parts. But this is the opening, I don't know, paragraph or lines.
Mm.
Over my 35 years in real estate investing, I've never, and never is capitalized, never seen an opportunity like what's ahead in the next couple of years. With a 6 million housing unit shortfall, we are on the cusp of significant market shifts. The coming years, 2024, 2025, will introduce new supply, momentary disrupting markets with flat rents and possibly price adjustments. Let's break it all down. So I'll stop there. He does go through some other things, but what do you think about that opening salvo?
Well, I mean, I agree that there's a big opportunity coming. I mean, this is something that I've been waiting for quite some time, right? Just on the basis that you can't have such a frothy, exuberant market for so long without there being some, you know,
Give
correction
back.
to it.
Yeah.
And
Yeah.
and you know what the last couple of years have taught us, and let's putting interest rates aside, right? That's just an exacerbating factor.
Hmm.
The supply issue just shows that the market works in housing, right? I mean,
Yeah.
this is just the plain old market cycle that, in real estate, that when everything is good for a really long time, you wind up in oversupply. Like it
Hmm.
just happens, always happens. It took a long time for it to happen this time because it took a long time for banks to start lending again, for people to start building again. But when they started building again, boy, did they build, right? And
Go.
yeah, and so what we've got is just a classic uh, real estate cycle happening.
Yeah.
The interest rate hikes and the expense hikes and all that stuff are really exacerbating the situation a lot, which maybe is why Ken McElroy is saying that this is kind of a situation he's never seen before.
Hmm.
But this was just inevitable that supply was going to catch up and then blow right by demand. And that alone is usually what causes the real estate cycle to end.
Hmm.
And so that's what we're seeing. And it just took a really long time in this cycle, right? So you have a lot of people who had an entire career within one cycle, right? Without
Yeah.
seeing a correction. And now
True.
it's all happening at once and people are really surprised by it. But I mean, Ken McElroy, if he's been in this business for 35 years, he's seen like
He's
three or
seen some
four.
stuff. Yeah,
Yeah.
he's seen some stuff. Yeah, the thing that I remember about this cycle, excuse me, is I got the feeling is it was very much like single family. I saw
Mm.
the same stupid assumptions, over exuberance, bad deals happening. And yeah, I knew this was coming. You're right. I think interest rates were the amplification,
Yeah.
took it up higher, and obviously will take it down lower.
Yeah.
So
I mean, I think sort of with your single family analogy, right? I mean, I think what was different about the past cycle was this was the first time you saw the entrance in a mass way of retail investors, right?
exactly.
The
Exactly.
syndicators exist, they've always existed, right? These deals were done forever. I think I've said it before on the show. They were called country club deals, right? You had some local developer or local investor somewhere made a business out of this, and it was he and his buddies and his buddies introducing him to their buddies, and soon you
Mhm.
had uh, you know a few dozen local rich guys who would invest
Yep.
in all these guys' deals. There was no internet, there was no podcasting, there was no social media. So this was all very localized. And didn't, if you didn't know any of these people, you'd never even hear about this.
Hmm.
What happened in the last cycle was because of technology, suddenly it became available to lots of people who never heard about it before, had no way of ever meeting a
Hmm.
local, a local
Yeah.
developer, didn't belong to the country club, whatever, right? And so, and also, I mean, the inflation, or I
Hmm.
guess the devaluation of the accredited investor definition also
Sure.
really expanded the number of people who could participate in these kinds of deals. So all those things kind of combined to just open this up to the masses in a way.
Hmm.
And that's why I think, you had so many of the people who would have gone into flipping, you know, and
Hmm.
did in the last cycle, or, people
Hmm.
like them, uh, they just all then this time around went into
Yeah,
multifamily. And
I think you nailed it, right? I went through the last cycle. I've got not quite 35 years, but almost 25. And last cycle, everybody was running around talking about single family homes, new builds, buying lots. I mean, it was just all single family, kind of individual.
yeah,
This time it was all, let's pool our money together. You're busy, you've got some money, I'll do it for you. And man, the number of new syndicators with no operational experience was frightening. So yeah,
yeah,
well, let's keep going. So next part of this long tweet: golden window for investors, in bold letters. So I guess that's the title. The imminent period offers strategic opening to acquire distressed assets at favorable prices. This includes properties from developers burdened by high rate construction loans and undercapitalized owners. Historical data post 2006 showcases detrimental effects of oversupply, setting the stage for today's deficit and escalating costs.
yeah. I mean, it's kind of what we just talked about, right? I mean, he's talking about, I think he's overcomplicating a little bit, but he's basically talking about the real estate cycle raising its ugly head, right?
Mm-hmm.
So we've got that oversupply situation, right? And he's combining it there with the interest rate issue, right? So
Yeah.
so you've got a lot of developers who are really staring into the jaws
Yeah.
of a dilemma, right? Because on the one hand, they're opening these properties are coming online at the same time that all these other properties are coming online. So you've got a huge problem, right, in terms of
Yes.
absorption. At the same time, they've got very high interest rate loans, and to refinance them, they're going to refinance. First of all, they can't refinance until they get stabilization, which doesn't happen without absorption, right?
Mm-hmm.
So they're
Yeah.
kind of stuck, right? Because they can't, absorption is slow, and they can't refinance until they do it. They're paying really high interest on these construction loans.
Mm-hmm.
These
Mm-hmm.
construction loans have personal guarantees, right?
Yeah.
These are,
They're in trouble.
they're
Yeah.
scared. And just so I don't know if I don't know what Ken said because I didn't read this tweet, but
Mhm.
just
Go
one of
for
the
it.
interesting things that has happened as a result. So, there's always been this idea in multifamily that if you buy existing property and you buy it below construction cost, which generally you can, so B and C property, that you're really insulated from additional supply because the gap between the rents for
Mm,
new product and for old product is very high. So the idea has always been, well, look, we're not that concerned about new supply if we're buying, B plus or B property
mhm.
because look, it's $500 more a month for the new build.
Yep.
And that's just it's a different customer base, right?
Sure.
So they'll have problems, but we'll be fine. What's happened though, is that so much supply has come on in these markets that those A-class properties are poaching the
Hmm.
B-class tenants by offering them free rent, huge
Yep.
concessions. So this has never really happened before, and certainly not on such a mass scale, where you've got the the B-class tenants moving up to the A properties and the
Hmm.
C-class tenants moving up to the B properties, and because everybody is slashing rents all along the way. You've got
Hmm.
places like yesterday I saw in Austin, Texas, rents are down 12%, like
Wow.
12%. I
12.
mean, that is,
Gee.
you're talking about like foreclosure
Oh,
when
for
you're down
sure.
12% in rents. I mean, you've got
Yeah.
now you've
You,
got your
you could
legacy
be,
rents.
You could be down 12% in an old property and be in trouble. That's a big
Well, that's what I
whack.
mean. Yeah. So, I mean,
Yeah.
and that's like market rent. So
Mhm.
obviously if you've got tenants who are there, you know, maybe you're keeping it at the existing rent or you're giving them a little bit of a discount, but and you're not going down 12%, but still it's hitting your bottom line. And a lot of people are right now in the position of like, just survive, like just get
Just survive. Yeah.
through this because
Yeah.
it is really wow. And Austin is just the worst of them, but there are a
There
bunch
are
of
others.
markets like that.
Yep.
Phoenix, San Antonio, like a bunch of these really
Yeah.
popular markets from the last few years are way oversupplied, and it's going to take a
Yeah.
while for that absorption to work its way through the system.
Yep. Yeah, I love how Ken called it the golden window for investors. Blackstone yesterday, I read, talked about generational opportunities coming. Now, Blackstone obviously has the bandwidth to go in and really save developers. They could come in and just finish projects and all of that. So pretty cool. Well, let's keep going with Ken's tweet. Commercial real estate's new dynamic. Unlike past bubbles focused on single family homes, today's concern center on commercial real estate. With banks tightening lending standards amid a commercial bubble, the landscape for investors is complex yet ripe with opportunity, especially in markets facing temporary oversupply but steady demographic growth.
So that is, those Sunbelt markets that we've been talking about. And I think what Ken is saying there is if you have cash and you can buy these properties uh, at a distress level and you're able to ride out this oversupply issue, right? So let's just say, for example, you're in the position to buy a property and just run it at 80% occupancy
Mhm.
because either you're getting it at the right price or you have good, whatever reason, like you're deep
Yeah.
pocketed, you can get good debt, or you can just make this happen. You can buy it cheaply enough. Then, in 2026, that this whole supply is just going to dry up. Like it's
Yep.
just, there's going to be no new
Dude,
supply.
there's no building coming.
Right. And
Zero.
this is like people are acting like this is weird. This is just what happens.
The
This is
cycle.
this
Yeah.
is the cycle, right?
Yeah.
So this happens every time. You have the oversupply issue when banks see that they're like, no more loans, and
Yep.
this new construction stops dead and all these deliveries get delivered, hopefully, and some of them will actually be stalled halfway,
Yeah.
right? And they won't get delivered. And then what will happen is it'll take a few years for occupancy to then go back to the normal level. And then once that happens, rents will start going up again. And then banks will look at that and say, okay, we're ready to lend again. So that could be several years.
Yeah.
And this is what happened in the last cycle. This is why it took so long for this massive wave of supply to happen because it took so long for banks to start lending on new construction in any
Mhm.
meaningful way. And meanwhile, everybody's going, look at this undersupply, look at this undersupply. So everyone's eyes were all big. And,
Mhm.
and so you just have this is just inevitable. This is what happens every time. So what Ken is saying is now this is the bottom of the cycle.
Mhm.
You can get in now and ride it up. But there's going to be a couple of years where it's going to be tough. So it's really all
Yeah.
about getting these assets at a price that allows you to
To wait it
run
out.
them, to
Yeah.
wait it out, run them at low occupancy and just wait for absorption to happen. And if you
Yeah.
can, you are going to make
Make
major
make.
money. Yeah.
You're gonna make. Yeah, this is why Blackstone's calling it a generational
Yeah.
opportunity. One more on this tweet, and I'll pull up another one. Strategic investment approach. So this is basically what to do. Success hinges on selecting assets that ensure cash flow and appreciate over time, not mere speculation. Understanding and leveraging migration trends, coupled with a sharp eye on markets with temporary oversupply, can yield significant returns.
Yeah. So essentially what he's saying is what I just said. Buy those, if you can buy the deal at a price that it cash flows and covers your debt service, then you're good. Because
Yeah.
then you just wait, right?
Yeah, run the numbers at 80%. And if you're good,
Right.
yeah.
Exactly. So what he's saying is don't go and say, oh, we know that, and this is what everyone was doing for the last 5 years. Look at these
Exactly.
demographics, what could go wrong? Well, when everybody's saying what could go wrong, well, what could go wrong is oversupply. And even you leave those interest rate
Overpaying.
issues. Yeah, well,
Overpaying.
you overpay and then you've got oversupply and then you're really screwed. Doesn't really, interest rates don't even go in. Like that's your next
Yeah.
problem, but you have a problem already with this oversupply issue. So, but if you can buy these assets at a price that allows you to cash flow them, even probably with some kind of onerous, like short-term debt or private money or whatever, because you're not going to get Fannie Freddie debt on something that's 80% occupied. It doesn't qualify, right?
Hmm.
So you're going to have to go with bank debt, you're going to have to go with private debt, or you're going to have to do it all cash. But if you, whatever financial structure you have, if you're cash flowing at a relatively decent, margin of safety, even at a low occupancy, then then you're good. As long as you're keeping your expenses paid, your debt service paid, you may not make a lot of cash flow right now, but man, in 5 years, when you bought this
Mm,
thing at the basis that you have, you bought the thing at a valuation where it's 80% occupied and now you're 95% occupied plus 5 years of rent growth.
wow.
I mean, you were going to be just sitting pretty. And this is why
Printing.
people made money at the beginning of the financial crisis, because
Hmm.
they were buying properties at like 15,000 a door, 20,000 a door, right? They weren't really making a lot of money at first, but man,
Yeah.
as
Yeah.
prices climbed and as rents grew, they just made out like bandits.
All right, we're going to switch to another tweet. If you are following Ken McElroy, this is the one I referenced yesterday in the Daily Financial News. This is the one that I guess has a red alarm on it, so I guess it means it's important. It says, "Read this to prepare for a potential recession in 2024." First up, build cash reserves. Prioritize saving to create a financial buffer. Examine your spending and then identify areas for reduction. High interest rates debt, especially from credit cards, can hinder financial growth. So focus on reducing these debts. What do you think?
I mean, I think it's always
Straightforward.
yeah, straightforward. It's always a good idea. Don't spend
Yeah.
more than you should. I think it's pretty straightforward. Yeah.
Yeah, I think for this one, for me, it's like cash is optionality on the future, right? On future
Yes.
deals.
Yeah.
You're probably going to have to put more down, right? You maybe in the last cycle you could put 20% down, but maybe you'll have to put 35% down,
Yeah.
right? So again, having more cash the better is my point there. All right, expense management. Analyze your operating expenses. Understand where your money goes and adjust accordingly. Cutting unnecessary costs can free up more funds for your cash reserves.
Yeah. I mean, the thing is though that it's most, at least professionally managed multifamily assets are pretty tightly run, right?
Mm,
It's pretty much a given that, when you underwrite a property, the only way that you can change the NOI is really to grow your rents, because you really can't cut a whole lot. Like you can't
mm,
do anything. Your biggest expenses are property taxes, insurance, and labor. And there's really nothing you can do about that. Like you could, I suppose, try to skimp on your property by cutting, like one of your uh supers, or cutting a leasing agent, but that's like cutting a vein, right? You don't
yeah,
really want to do that. You don't want to skimp on maintenance, and you definitely don't want to skimp on leasing, right? Especially when absorption is
yeah.
tough. So you can't, it's really hard to cut expenses. Utilities, they are what they are,
Hmm.
water usage. I mean, most properties at this point, they've already been through low flow shower heads, low flow toilets, all of
Right.
that stuff. There's not a whole lot. I mean, if you find a property that's got old fashioned toilets and shower heads in it, like great,
Hmm.
that's an easy value add. But
Right.
those properties, maybe for smaller properties, older properties, you find that, but for the bigger properties, everybody's already been there, done that, and so it's hard to cut expenses. It really is.
Asset capitalization. Reflect on the past economic downturns. Those with available capital during the '08 financial crisis could invest in undervalued assets. Similarly, prepare to identify and capitalize on investment opportunities that emerge during a recession.
Yeah, I
Again,
mean,
straightforward.
pretty
Yeah.
straightforward. Yeah, I mean, this is why in the years leading up to the the crash, and even before the real bubble happened, I got into a lot of Facebook fights with people for saying you guys should be getting cash together now. And
Yeah.
people were like, you can't have uninvested cash. You can't have
Yeah.
uninvested cash. You'll lose it to inflation. And inflation was 2%. And I was
Ah,
like, look, it'll,
yeah.
the typical correction is 30%. If you wait 10 years, right? It'll take you 10 years at 2% inflation to lose 20%. You could lose 30% overnight if you
Mm,
reinvest at the top of the market and you don't take profits. So why on earth do you
mhm.
think you need to have every penny invested? it's just, you're just setting it up to lose it, right? So, but
Hmm.
people were like, you're stupid. You have to have, you're losing to inflation. You have to have every penny invested. No, you got to have a
Yeah.
cash reserve to take advantage of those once in a lifetime opportunities, because that's where the real money is made, right?
Hmm.
So, yeah.
Couldn't agree
And
more. All right, here's one that I know you'll like. Banking strategy. Banks facing defaults may seek to offload real estate and other assets at reduced prices. Position yourself as a solution to their problem and be ready to purchase these assets.
yeah, you got to go talk to the banks, get ahead of this. And I think the opportunity, honestly, I think that, for big banks that have big assets, big buildings and stuff, it's going to be harder for the average person to go into that bank and say what you got. But go into your local bank, if you're in a town somewhere like Michael, where you are in
Hmm.
Fresno,
Hmm.
like if
Yeah.
you have a local bank that you do business with, or frankly, just go into all the local banks and just start talking to them, because they
Hmm.
definitely have multifamily loans,
Hmm.
and or housing loans or whatever, commercial property. You want to be the guy that they know who's going to be ready to
Yep.
buy that stuff. And frankly, just as we've said, we've had, um, like a whole generation have their entire real estate career during a boom.
Yeah.
These REO guys at these banks, they haven't had anything to do for 15 years,
For a long time.
right? They may not even have an REO officer, right? Or they may just have hired one and they don't know what they're doing. So these people, they're going to, like, they don't know who the buyers are, right? They're
Oh
going to
yeah.
need you. So go in and
Yeah.
get to know them, because they have not dealt with this problem for a long time.
All right, here's another one that's it might be an interesting talk. Expand your skill set. Ensure job security by diversifying your skills. Offer to take on additional responsibilities or learn new areas of your business to make yourself indispensable.
Yeah, I mean, I think that's good advice at any time. But I'll just share with you guys like something that I've been toying with in the back of my mind. Like,
Okay.
there's a lot of buildings that are going to go into receivership. They're going to need asset managers.
Mm,
What do I
yeah.
do? Right? What do I do for a living? I mean,
Yep.
I should be going to talking to banks about, hey, when you need to have these assets managed for you while you're after you
Yeah.
foreclose them, that's like a whole new line of business I could open up. Right.
Oh, for
So
sure. I mean, again, I was buying in the last cycle, buying multifamily. Banks had no idea what to do with. You know what the banks in my market did? They got the tenants out, they boarded it up, and that was their asset management. That was their plan. That
that
was
is
it.
insane. Yeah.
Yeah. Now these were smaller buildings. These weren't big ones. But yeah, I mean, I bought plenty of buildings, like
Yeah.
10, 20 units, boarded up. It was wild.
Wow.
Um, let's close on this one. Embrace opportunity. Economic downturns can create opportunities for those that are prepared. Stay alert to emerging trends and sectors less affected by or benefiting from the recession. Right?
Yeah.
Where there's great pain, there's great opportunity.
I mean, this is just the Warren Buffett thing, buy when others are scared. This
Yeah.
is be greedy when other people are scared. I mean, it's always easier said than done, because liquidity is a problem. It really depends on having cash reserves or being able to get your hands on cash. So that means, if you don't have the cash yourself, talking to people who have the cash, and there's still the opportunity to be the person who puts the deals together for the people who have the cash and don't have the time. And the task that you'll face, though, is those people will be scared because they're reading the news and they're not really savvy investors. So they're thinking, because listen, most people are not savvy investors. So they just think, oh, bad economic times, I should just hunker down and not do anything and wait for better times. They really have to understand that these are the best times to be buying, and that's your job. But if you've got the cash or you can get the cash, there will be some bargains to be had. So I'm really looking forward to this. In the hotel space, the multifamily space. I mean, just think about it for either multifamily or hotels, and putting the whole distress thing aside. Just imagine you're a multifamily owner or a hotel owner who's reached the end of it's time to sell. You're done. You want to
Yeah.
retire. You're too old to continue. You're too tired to do this anymore. It's too much of a headache. You've decided to sell, and you're trying to sell into this environment, right? You're going to be either reducing your price a lot, or you're going to be open to seller financing. maybe
Exactly.
even want seller financing because you want to have some more this has been
Yeah.
your income all along. You still want to have income. So, you're willing to
Yeah.
do seller financing deal. I think that this is the time for those kinds of things to be available. And you just have to be out there looking for those opportunities.
Yeah. I couldn't agree more. Here's another one from Ken. Debt is a strategy, and it should be used as a strategy to increase your personal wealth.
Yeah, agreed. Like there are definitely people out there who say debt is terrible.
Hmm.
And certain kinds of debt are bad. You don't want credit card debt. You know, I don't think having car payments is a good idea. Like things like that, where you're just, kicking the can down the road
Hmm.
is bad debt, but good debt is debt that allows you to make money, right? So
Yeah.
taking on debt to buy real estate that's cash flowing. So if you take on debt to buy real estate that cash flows with a margin of safety, so that you're not in a position if you lose one tenant, then now you're out of
Hmm.
pocket on the debt, but you can be, you buy 20 units, you're able to still cash flow if you lose five tenants. Like that is something you should do. Take on that debt
Hmm.
because that debt will pay you back.
Yeah. So this is Ken again. I'm over 700 million in debt. Again in bold letters, just to kind of shock people, I'm sure. To your point, this is what he said. Using good debt to invest in income producing assets such as real estate can result in tax-free cash flow and wealth transfer through estate planning.
Yeah. I
Just
mean,
simple, right?
yeah, and that's a shock headline. I mean, his net worth exceeds his debt. So he's not in debt, right? He's just saying he's on
Yeah.
the hook. He's on the hook for all these loans. And who knows? I'm sure a
Yeah, but
lot
I
of that.
bet you a lot of them are personal guaranteed. No.
Yeah, I'm sure almost all of that is non-recourse agency debt.
Yeah.
But nevertheless, I mean, he makes the point that debt is a tool and use it
Yeah.
accordingly.
The other thing that I've heard Ken McElroy talk about, I'd love to get your opinion on is there's a lot of people pointing at office and saying, hey, why don't we just easily convert this to apartments? And I know New York has done some of this over the years, but is it really just the footprints and floor plans aren't conducive or what?
Well, so there's two issues. One is that the floor plates are very big, and under the law in New York City, and I'm sure the law in a lot of other places, you need to have windows in
Yeah,
bedrooms. And where you've got these
egress. Yeah.
huge floor plates, you've got windows on the outside, but you've got this big area inside that has no windows. Now,
Hmm.
there's also the issue of plumbing. Most of these office buildings have plumbing. If you think about like a typical office building, what do
Yeah.
you have? Men's room, women's room, and kitchen, and they're all next to each other in one
Yeah.
place. And then you've got all the offices around the edge. So installing the plumbing is a huge expense.
Yeah.
But these problems are not insurmountable, right?
Mm.
They can be overcome. The issue really is, can you buy the property cheaply enough so that you can then afford all this capex that's going to be necessary, right? And can you afford to have like this dead space in the middle? I
Hmm.
think personally, I mean, I've been in buildings in New York City that were like old trading floors, and essentially what you did is like you walked out you got off the elevator, and there was basically like an enormous lobby on every floor, and the apartments
Hmm.
were around the edge. So there's no reason why you can't do that, but that space can be repurposed in many ways, right? You can put nice lounge areas there for people to gather. You could do self-storage. You could put
Hmm.
laundry in there. You could put pickleball in
Yeah.
there, frankly. Like there's lots of things that you could do with that space. But the issue really is like if you buy the whole building on a square footage basis that's cheap enough, it doesn't really matter what
Hmm.
that there's this dead extra space. Right. I think the issue really is rather than the dead extra space, it's the window requirements and
Yeah.
the the cost of running plumbing for
Okay.
apartments. Yeah.
Yeah. Yeah, at the end of the day, when I look at what Ken McElroy's doing, what you are undoubtedly doing in your bigger stuff, I come back and Blackstone, right? Blackstone kind of let it off yesterday with generational opportunities ahead. I think about the little guy, right? The person that might be buying a fourplex or 8 units or up to 20 units. And I want them to realize that the same pain that we just went through exist in those units. I saw people doing syndications in little 10, 15, 20 unit buildings. It was two or
Yeah.
three friends came together. So the same stupid behavior with the stupid assumptions, with stupid debt, it happened at smaller stuff as well. Is that fair to say?
Yeah, absolutely. I mean, this is not a problem that just occurred in these big, 200, 300 unit properties. I mean, you'll see this with 20 unit properties, right? A lot of people were doing smaller syndications, especially as the prices went up, right?
Yeah.
And, you know, the door prices went from, 30K a door to 150K a door. Suddenly, for a 20 unit, you've got to syndicate it because you can't just buy it anymore, right?
Yeah.
So, and I think that a lot, frankly, just reversion to the mean means a lot of that a lot of that pricing is going to go into reverse.
Yeah.
So a lot of
I think
people are
so.
going to be losing a lot of equity because they just overpaid. This is
Yeah.
just what happens.
We're hearing more and more, at least I'm reading on the Real Deal, about just the obvious losses coming to LPs. Just again, I think a month ago or 6 weeks ago, we talked about being very early. It's still early. There's still I think a lot of people have their head in the sand,
Yeah.
hoping that Powell cuts rates by 100 basis points out of nowhere or something. But yeah, the pain is still building, right?
Yeah, absolutely. And I think that's also, it's going to make it hard to raise capital for a while because
For sure.
a lot of people will have been burned. And once you touch a hot stove, you don't touch it again. So I
Yeah, there'll be
think,
people that never come back.
yeah, yeah.
Yeah. Jonathan, you're amazing. Where can people follow you? I know you're doing a lot on LinkedIn these days.
Yeah, I think LinkedIn is probably the best way to follow me these days and join the conversation. So just look me up on LinkedIn. I love it when people drop me a note saying that they're from this channel. It's been
Thank
happening a
you.
lot recently, so keep it up. Yeah, looking forward to talking to you on LinkedIn.
Awesome, buddy. Thank you so much.
Thank you.